Today, our latest mortgage stress analysis. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, last Tuesday I ran a live stream, and embedded in that stream is my latest analysis relating to mortgage stress. But I've had a number of people ask if I could pull that out and make a separate show based on that same material. So this is what this is today. This is my latest analysis, including the mapping, the detail down to a postcode level, and also my main observations relating to what mortgage stress is looking like and where it's progressing. So I hope you find this useful. The way that this all works is that I have my core market model. The core market model includes our surveys, so I'm updating that information tonight to the end of March. It's weekly data, quite current. I also slice and dice the data, so we can look at some of that later. And the core market model allows us also to look at some of the scenarios. I've made some changes to my scenarios, given the trajectory of interest rates, so we'll talk about that. And also, of course, we can take the stress, the trajectory of prices, the buying and selling intentions, the migration data, the economic data, the CPI, wages, employment, all that stuff, bring it through the core market model. And that allows us then to form an opinion down to the postcode level. And I have my postcode engine, which means that if you want to talk about a particular postcode, we can do that. And also, if you want to have a more detailed conversation around a particular suburb, I still run the DFA 1-to-1 sessions. It's an individual confidential discussion. I don't give financial advice, but I can talk about the data and some of the underlying trends. I can look at the stress, home price trend data, and perhaps thoughts about where prices may go based on our modelling. You can also book a time for that, about an hour's conversation, either by phone or by Zoom. There is a cost involved, and it's payable in advance. And if you're interested, you can contact me via my blog. The links are below. It takes about 3 to 5 weeks to book ahead because I've got quite a lot on. Now, what I will just do is pull up the postcode engine, because, of course, I do have the postcode engine up there as well. And just so you understand how this works, I have data for every postcode in the country, well, pretty much every postcode. And so for postcode 2000, for example, I can tell you that there are 13,800 households, there are 1,700 borrowing, 10,800 renting. There's 74% of households in that postcode in financial stress, of which 33% are in mortgage stress, 65% are in rental stress, 75% are investor stress, so the investors are really finding it pretty tough at the moment. And then I've also got some projections in terms of what prices may do in our bearish, bullish and neutral case. And over the next 3 years, I'm saying there's not much happening. There may be a slight rise. Worst case, a fall for houses of maybe 16%, not that many houses, mostly apartments now. Of course, units, though, falls of perhaps 12%, or about bullish case of 1.3%. Now, all of this information for every postcode is accessible via our portal. And so if you want more information about a particular postcode, then you can sign up via Patreon and get access to the portal, which gives you all of the information that we actually have for that particular postcode. It's updated every month, and so you can see the trends over time. And the portal that we provide allows people to compare different postcodes. It allows you to look at projections. It allows you to look at some of the trend information as well. So it's actually quite powerful. You can get access to all of the data I've shown to light for every postcode pretty much across the country, more than 2,000 postcodes. It's a particular stress subscription, and it's $50 US a month, including in GST. Go to Patreon, sign up. You'll get access then to the history as well as the current, and as well as individual postcodes. You can compare and contrast across different postcodes, look at some of the projections, and download the entire postcode set so that you can do your own modelling. And every month from the portal, you can grab the whole data set, which is pretty powerful. And it is interesting. This is the ASX 30-day interbank cash rate futures. And I just want you to look at the sequence down the bottom here, because what this shows you is that this was before the RBA announcement. We were looking at rates of more than 1% by October and 3% by August 23. But if you then look a day later, you can see now that we've got 1.4% by October and 3.3% by September 2023. So what this has done is this has pushed the expectations from a market perspective up. And so everybody now in the market is saying higher interest rates sooner. And that could be 2 or 3% in the next few months. That's a big increase based off very low base rates that we have. And if that's anything like right, and of course that's much more extreme than what the Reserve Bank is actually signalling, but it looks to me as though that's more perhaps in line with what may happen. And remember, of course, that the Federal Reserve will also potentially lift rates further, even 50 basis point rises. And that means that the net effect potentially will be to have rates higher faster than a lot of people are expecting. Expect the unexpected with regard to future interest rates. Now, just a quick reminder before we look at the stress data, that the aggregate data for credit growth was pretty strong, with owner occupation at 8.9, overall housing at 7.8, and investment up 3.9 over the last 12 months. Very strong. So it also begs the question as to whether, in fact, the APRA should be tightening back the lending controls. In that statement that I mentioned earlier on from the Reserve Bank, there was a comment about lending standards need to be kept tight. Well, I can tell you that there's a lot of lending being done that shouldn't be done at the moment, particularly with those higher interest rates ahead. So I do think this is going to come unglued at some point. And this growth in credit is extreme and potentially can lead us up the garden path later, I think. And on that thought, it's also worth noting that the debt-to-income ratio, which I actually discussed today in a post, I'll come back in a second, is higher than it's been. That's now 185. This is the RBA scrambled figure, and so it's not giving a very accurate view. Remember, it's just an average across all households and all debts. The household debt, of course, we're talking about here, so it excludes firms. But interestingly, the housing debt-to-income ratio and the owner-occupied housing debt-to-income ratio, they're all rising. So whatever you may think about the ability to service debts with low interest rates, the debt-to-income ratio is a problem. It's higher than it was back in 2001, or indeed at any time up until quite recently. And just on that, if you want a deeper dive on the analysis and also what the assumptions are that the Reserve Bank makes when it actually talks about these ratios in their monthly or quarterly series, I did a deep dive on household debt and income ratios today, and I took apart all of the various charts and also the underlying assumptions, and that shows that some are seasonally adjusted, some not. Some are including firms and some not. And there's a bunch of assumptions that people don't understand in those numbers. So they are a bit deceptive, but the bottom line is that the debt-to-income ratio is rising, and that's a problem. Wages growth expectations, of course, remain relatively muted. The budget also showed that, maybe, if we're lucky, wage prices might overtake the CPI later. But at the moment, we're in the situation where real wages are going backwards. And just think about that. We have the situation where we have big debt, where we have interest rates rising, and we have real incomes going backwards. And of course, all the rising costs from the pressures to do with supply chains and all those things as well. So those are the factors that need to be put into the model when we think about what's happening. And by the way, the average loan size for unoccupied dwellings continues to rise. It came back slightly in New South Wales, but actually compared with 12 months ago, the average new loan is a lot bigger. So people are getting leveraged into bigger loans because of the low interest rates. Now, that takes us nicely to the mortgage stress. And so this is to March, and this is based on my analysis. And so the first thing to say is that the mortgage stress is now at 42.2% of households. So that's pretty much as high as it's ever been. So it's an increase from last month. And it's worth just noting the significant move compared with February 2020, when it was 32.9. Now, that's a relevant date because that's pre-COVID. So since COVID has come, and since all of the government stimulus and low interest rates, overall mortgage stress has moved up 10%. That's a big move, and it's still going higher. And that is a concern, as you'll see a bit later. Also, just again, the household debt ratio is 186.2. You can see that's now back up to as high as it's ever been. Remember, that's with the household debt ratio, facing into very low interest rates, but what happens when interest rates rise? That's the key question to ask. Now, these are the stress data sets for March. And let me just remind you again that stress is defined in a very specific way here. It's not a set percentage of income going on the mortgage. Okay. What I look here at is total cash flow, money in, money out. How much money is coming in after tax? How much money is going out on all the various expenditures, including the mortgage or the rent or whatever. And if there is insufficient money to be able to cover all the outgoings without grabbing more credit, then they are classified as in stress. Now, of course, you may have savings, you may have assets that you can convert, but if ultimately you've got a continued situation where every month you're spending more than the income that's coming in, that ultimately is going to spell disaster. And that's what I'm measuring with this particular set of information. So in this set of information, you can see here that overall mortgage stress is now significantly higher than in February. In February, it was 41.59, and in March, it's up to 42.15%. So not a huge rise, but a significant rise. And if you want the numbers, it was 1.524 to 1.539 million households. And I've also just highlighted where the pressure is. So in yellow, these figures are higher than last month. So in the ACT, mortgage stress is higher. New South Wales, it's higher. South Australia, it's higher. Tasmania, it's higher. And Western Australia, it's higher. It's a little down in Victoria, Queensland, the Northern Territories. If I look at rental stress is now at 41.8% of those renting. And again, we've seen growth in stress in Queensland, South Australia, Victoria, Western Australia, 41.81. Investor stress, so these are property investors, and that includes people who are trying to sell their investment property, who've been unable to let it, or who have let it but are not making enough to cover the costs of the investment itself. And about 25% of those investors are in difficulty. And interestingly, the highest proportion is in New South Wales, and also we see Tasmania and Victoria and Western Australia at around 23%. And then finally, financial stress, which is the aggregate measure across all households, and they're at 41% of households, or in financial stress, just over 4 million households out of the 9.5 million. That's quite a big number. And you can see there that New South Wales holds the prize for the proportion in financial stress. Then we have Tasmania. Then we have the likes of Victoria, and we have Western Australia at 38%. So you can see there a significant story in terms of what's going on. We can just take it a bit further by looking across our segments again. And as always, I highlight, of course, young growing families, a lot of first-time buyers there. So a lot of new buyers coming into the market are in financial stress at 60% and in mortgage stress at 75%. So in other words, 3/4 of first-time buyers and young growing families are having cash flow issues. That's gone up again. We also got battling urban disadvantaged fringe households there, sitting in those new high-growth estates. Significant pressures there. And you can see that there's pressure across the board, but those 2 or 3 areas are the ones where it's most significant. Then we go to rental stress, and more mature, stable families and the multicultural establishment, the first-generation Australians, is where the highest degree of rental stress is, plus the young affluents. So a lot of younger people who've got bigger incomes but are having to pay a lot of it out for their rentals, which means that more than half of the young affluents are actually in stress at the moment. And if we go to the investor stress, you can see then we've got quite a lot of movement, young affluents. This is very interesting, of course. I keep calling this out. A lot of young affluents really don't know what they're doing when it comes to their property investors. So they're piling in and getting into difficulty. A lot of exclusive professionals who, again, have lots of property aren't necessarily finding that they're all performing as well as they would like. And we've got a lot of first-generation Australians, bit the same, struggling with their investment properties. And overall financial stress is highest across all those groups of young growing families, the young affluents, and the battling urban. So you can see that this is not just one or two groups. It's quite widely spread, and it's getting worse, which is not a good look. Now, briefly, what I can then do is just go through the various postcodes. And I won't do this in detail because you can always look at it later if you want more detail. But it gives you a bit of a flavour of the types of areas where the mortgage stress is highest. Now, there's always an interesting question about whether I show this as percentages or whether I show as the count of households in stress. I choose in these shows to show the stressed count because I want to show you where the big numbers are, because the large counts are probably the most significant thing. But, you know, it is, as you'll see as we go down the list, some have a higher or lower percentage, and you could look at an alternative. But, of course, the danger is if you have a very small percentage, a very small number, I should say, with a very high percentage, you might end up with a misleading sort of story in terms of what's precisely gone on. So let's just quickly get down there. Toowoomba in Queensland, 4350, is unfortunately the postcode with the highest count of households in mortgage stress now. That's up in Queensland. We go to Western Australia, to places like Hocking and Tapping, more than 9,000. We then go to Victoria, to Narre Warren South, postcode 3805. Bear that in mind, 3805. You'll see that coming up in another slide in a moment. More than 9,000. Then we've got 3806 next door, Berwick and Harkaway. And then we've got another Victorian postcode, Roxburgh Park, 3064 at more than 7,500. Cranbourne, so you see this great sway, the Victorian high growth, high corridor, high development postcodes. Then we go up to Queensland to Pine Mountain, down to Western Australia to places like Quinnslock and Ridgewood and Tamala Park. Then we come back to Victoria to Sydenham, then to Pakenham, then to regional areas like Ballarat East, then Point Cook and Derrimont, Mount Annan in New South Wales, and then G-Bug in Queensland. So you can see that some really interesting moves compared with last month. Those of you who remember what happened then, it's worth comparing. So more Victorian postcodes in these high growth areas are in difficulty. To the same for rental stress, and there Victorian postcode 3000, centre of Melbourne, is the postcode with the highest count. That's a lot of course, high-rise development that's gone on close to the city centre in Victoria. And a lot of those rents are sky high and people are still not earning as much as they were. Toowoomba's on the list then. Then we go to New South Wales, to places like Campbelltown in postcode 2560. And then we go to another New South Wales postcode 2540, which includes places like Sussex Inlet and Falls Creek, more than 9,500. Then we go to Mount Druitt and Lethbridge Park, 2770 at 9,300. Another postcode, this is North Gosford and Gosford, of course in the Central Coast, with 9,100. And then we go to Chipping Norton, Liverpool, Mount Pritchard, places like that, 8,900. Then we go to Blacktown, more than 8,000. Then we come back down to Victoria, South Yarra. And then we have a couple of Queensland postcodes, places like Pacific Pines, and we also have Surfers Paradise. So again, the problem there is that the rents are very big and the incomes aren't. Then we go back to Surrey Hills and Darlinghurst in New South Wales, and Bondi Beach off the bottom of the chart there. Finally, we can go to the stressed investors, and once again we find that there's some interesting footprints with Queensland in 4670, and also Surfers Paradise with significant numbers of investors struggling. That's a combination of big costs to get into the property market and also rentals under pressure. Melbourne Victorian 3000 with more than 3,700 investors struggling. Another Queensland postcode, Labrador Southport, postcode 4215. Then we have Surrey Hills and Darlinghurst. Then we go to Greystanes and Wentworthville and Westmead with 3,400. Then we go to places like Wagga Wagga, which is interesting, 3650. So we have some investors there struggling. Back to Newtown, postcode 2042, 3300. And then we go back up to Queensland again, down to South Bank, and on it goes. And just finally, to give you the aggregate view, of course, we can also then look at financial stress. And as you may not be surprised to see, some New South Wales postcode at 2560 and 2170, then Toowoomba, then some Victorian postcodes, including Victoria and 3000, Cranbourne, Derrimut, then some Queensland ones. So you can see it's across a whole bunch of different areas, but you can see the same pattern. High growth corridors, a lot of new developments, a lot of people who've bought relatively recently are struggling. A lot of property investors are still not being able to let those properties to generate significant income and revenue, and the costs of rising in terms of trying to maintain those properties. So there is a big set of issues here. This is a big number, and I don't think it's going to get any easier in the short term. And remember, this is before interest rates really take off. So you would expect to see higher levels of stress as rates rise ahead. Okay, so that's the latest then on the stress story. Now, just before I move on and look at the comments and then show you some of the mapping, let me just make this point. I want to highlight the impact of higher interest rates because it is very significant. And I got this little model here. This is from CBA. At 1.99% on a 30-year mortgage, the overall repayment for $100,000 would be $365 per month. So if you go for 600,000, you multiply it by 6. If you then put that rate up to 3%, you go up to $422 a month per 100,000. That's an increase of 15.6%. And if you go up to 4%, the repayments per month goes up to $478 per month, up 31%. And the point I want to make with these numbers is that the interest rate movement can be quite small, just a few percent, but the impact on the monthly repayments is significant. It's much, much bigger, and that's because, of course, the relative payments that you're making on the interest payments relative to the capital repayments grows up very much more quickly. That's what people don't understand. And so when people talk about, these rate rises 1 or 2%, it's going to be easy to cope with, you should be thinking about the actual increase in the real monthly repayment. Now, of course, the banks will say, well, we can extend the loan for another 5 years or 10 years or something, make it duration or go interest only. But at the end of the day, the mortgage still has to be paid back. So that's why this is a big deal. And in terms of rate sensitivity, this is the latest modelling I've done. So I've taken the model and I said, what happens if rates were to go up 0.5%, 1%, 1.5%, 2%, 3%, 4%, 5%, 6%, 7% today in my model? And remember, we've got 1.4 million households, or 1.5 million, in stress. Well, you can see here that the growth rate is quite significant. And essentially, there's a lot more, another 1.6 million if rates went 7% higher, which is, long-term increase. That might not be such a long way out. But the point is, there are a lot of households who are beginning to get impacted. That's one reason why I think household financial confidence is going to maintain relatively pressurised in the short term. And what I always want to say about this is just a rough indication because, of course, there are some feedback loops too. So, for example, if in fact we're in the situation where interest rates go up, businesses will invest less. As businesses invest less, they will be less able to pay wages and they might have to dial back hours. So there's a feedback loop there. And so not only will the rate rise hit, but also potentially the hours work might go down as well. And it's some of those feedback loops that the modelling that I do tries to capture as well. All right, so with that, we might just go on and do some of the stress mapping simply because I do happen to have that information readily available. And the point about the stress mapping is that it helps me show you where the hotspots are visibly. And this is Melbourne first, Melbourne 3000, it's mortgage stress. And you can see here that, remember that 3806 postcode and 3805 postcode that I mentioned earlier on? Well, it's sort of there, right? So that's a big splodge. And that splodge is the high penetration of stress. And you can see how it circulates around the high growth corridors, Point Cook, Derrimont around here, down towards Dandenong here and Frankston, places like that, and then out in Ballarat. And if you drill in, you can sort of begin to get a bit of a feel for precisely where those footprints are. Some of the areas north of the city are also feeling it, places around here as well. And closer in, mortgage stress is less of a problem. And in some of those inner suburban areas, again, it's not anything like as severe. But the point is the big numbers are in those more extreme colours, and that's a problem. Now, if I then go to Sydney, and we just start in Sydney postcode 2000 and just pull out a little bit, you can begin to see that once again we have little hotspots. And if you remember what the maps looked like last month, they're not dramatically different, but what is true is that the numbers are just a little bit higher, and you start then seeing some of those Western Sydney suburbs like Liverpool come in. That's where there's a big hotspot. And as you pull out further, you can see that some of those northwest regions around Blacktown are also there, and Campbelltown. So there are some of the really big hotspots for mortgage stress. Pull out a bit further, you can see that this is a relatively consistent pattern. And so you've got the western suburbs and the western Sydney. Closer to the city, things are quite a lot better. But again, there are a few hotspots with a few, but it's western Sydney where a lot of the problems are. Maybe not surprising, but it is actually quite worrying to see it continuing to grow. And actually, before I just do that, let me just pull out slightly further. I just want to make one other point. If we go slightly further out, I can just begin to show you that over the dividing range, places like Orange are also feeling it too. So it isn't just the areas around Sydney, but there are regional centres too that are also feeling the pain as well. What we might do is just go to Brisbane. And, the story in Brisbane is not as extreme as you perhaps might expect, although prices have now accelerated considerably, and the latest debt ratios that are actually being displayed there are very significant. But you can see already some hot spots like Camp Hill, for example, 4152, places like that are beginning to show it. And as you pull out, you can see that Ipswich is on the radar as well. And there are, again, some regional suburbs, as well as those in and around Brisbane, where the relative numbers are quite a lot higher. And, of course, the absolute counts relative to other parts of the country will be a bit lower because of the population footprint. But nevertheless, there are some significant pressure points here. And if you go down into places like the Gold Coast, again, not the same high counts as some, but those are still quite significant counts. But this Ipswich area in particular is one that concerns me greatly at the moment. And if I then go to Hobart, just to highlight the point that, again, the total numbers are quite a lot lower because the population base is a lot lower. But Hobart is also a place where there are considerable housing pressures. The prices have risen dramatically. The demand for rental accommodation is extremely high as well. And this is putting a lot of pressure on households. So you can see that there are areas around Hobart that are actually beginning to be quite concerning as well. And I might just do one more. Now, the point I want to make about all of these mappings is it shows you how diverse the mortgage stress is, and it's not uniformly spread in any way whatsoever. It really does depend on where you look and what you see. And we could do the same. I won't necessarily do it now because we're running quite short on time, but I can do it also for rental as well as for mortgage stress and for the investor stress as well. Story in Perth, it's not too bad in and around the centre, but if you go north and south of the city, some of those new high growth areas, particularly up around here, definitely a problem. And once again, the same old, same old. There are some suburbs where there's a lot of issues. So in summary, then, you can see that the patchwork quilt of mortgage stress continues to develop. As it evolves, we see quite considerable differences in terms of what we find. And frankly, I think the story is one of continued pressure on households over the next few weeks and months. Now, as I always say with my scenarios, the scenarios are just a way of exploring the different futures and looking at the consequences, not forecasts. It does move around a lot. Scenarios are based on what we see today and running forward over the next 2 to 3 years. And the bottom line is this, that there are various ways this could play out, and what I tried to do is capture some of those in my scenarios. Now, I've made some changes. So the RBA baseline is now, over the next 24 to 36 months baseline from now, is the RBA rate at about 1.5%. That is where I think the RBA is thinking. Unemployment 4 or a bit below. The mortgage rate would translate, and I've now started including a mortgage rate in this set of scenarios, about 3.5% on average. Mortgage stress about 38%, and I reckon there's a little bit of move on a house price, a little bit of a slide, maybe some slide upside of homes on standalone blocks. And effectively we see some rate rises over the next couple of years and the end of quantitative easing. I give that about a 10% probability. On my base case, this is the one that I think is the most likely at the moment. I'm thinking that the Reserve Bank rate, cash rate, will be perhaps 3% over the next 2 to 3 years. So that really is a bit below where the markets are, but not dramatically so. I think they'll be forced to do it. I think as a result of that, the unemployment rate will be higher, 4.8. Still quite low, but it's still higher than it is today. The mortgage rate would translate to maybe 5, maybe 5.5%. Mortgage stress would be higher, but 45%. The losses would be higher. And the downside would be 25% down on properties. Again, that some will continue to move up, particularly houses. We will see lots of extra incentive to try and pull people into the markets, particularly after the election. More first-time buyer incentives, bribes, whatever you want to call them, all that sort of stuff. And I think there's about a 50% probability of that actually playing out. Then we've got to think about the longer-term crunch. So what happens if, in fact, things don't go and we get higher unemployment, and as a result of that, the inflation dissipates, and in that case, the RBA might be forced to take rates lower, close towards zero. That would give us a lower mortgage rate. The mortgage stress would perhaps be about 40%. And even so, I think we'd probably see some falls in prices, 25% scenario there. And then the other one is what I call the multi-wave disruption. So that's things like the conflicts continue to escalate and some of the broader issues. And look, if things went really badly pear-shaped, we might actually sort of be seeing much higher unemployment and very low mortgage rates and higher levels of falls. I think this is pretty unlikely, but I've put it at 15% at the moment because there are so many uncertainties. But if you wanted my best view, and in my models I use the first 3, by the way, I think this best case scenario is probably reasonable. So there is still a path for some further increases, but also the downside is quite strong, and I think we're going to see more downside going ahead. The fact of the matter is that the momentum is going to ease as the interest rates rise. We know that listings are also quite a lot higher now than previously, and all of those things together play into my scenarios. And just before I go, I want to highlight 4 things about mortgage stress. Most households who are in mortgage stress or rental stress or investor stress don't realise they've got a problem because they don't have enough information about their cash flows. They don't run money in, money out. So the first thing is I'd recommend everybody get to know your cash flows. Understand money in, money out. If you want some tools, the ASIC Money Smart website has some very good tools for budgeting. Second, once you've done that, you can then prioritise and see where the money is going, and maybe there's some things you can turn off and prioritise differently. Look at high interest liabilities too, because those are the things that actually will be very significant, and get rid of those first if you possibly can. That includes the credit card if you're revolving credit cards. If you have a mortgage and you've got issues, the lenders are required to deal with you fairly, and it means that if you have an issue, talk to them, because under their hardship schemes they have an obligation to try and help. Now, sometimes they're unable to help because it's too far gone. The sooner you talk to them, the more likely you are to be able to actually deal with it. Don't just put your head in the sand and assume that somehow magic's going to fix itself. I don't see income growth going to drive very fast. Cost of living will continue to rise. So it's really important to take those early steps and tackle it early. And then finally, what I'd say is, when you've prioritised and thought about what you're actually spending your funds on, not everything is equally important. Maybe you've got to give a few things up for a period of time, because this is about discipline more than anything else. And what I find in my surveys, a lot of people who've got these stress concerns, and by the way, these stress concerns can really manifest themselves in physical ways, that people get ill and all those things too, or violence, all those things follow. So there are social consequences of this sort of stress. So it's really important to tackle it early. And point one is you've got to recognise it. So if you think you have an issue, go through some of those processes and reach out, get some advice. There are financial counsellors. Go for the free ones that are actually provided by the states and territories. Don't go for those that offer to solve your debt problem by charging you an arm and a leg. There's a lot of those about. They are disgrace. They should not be there, but they are there. But be careful about that. But nevertheless, it's important to sort of tackle it early and tackle it right. So there you go. Hope that is a useful little thought in terms of how to deal with it. There's not rocket science. This is just money in, money out. How much money is coming in? How much money is going out? Prioritise, select, and also make the point: if you are a new borrower going into the market now, do your own calculations on a rate rise of 3%. Can you still afford it? Because you've got to assume that rates are going up 3% or thereabouts. So in closing, just to say, I will update the mortgage stress analysis again next month with more information. And always follow me, of course, on my various social channels so you get the latest as soon as it comes out. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.